And there we are. All right, welcome everyone to this special board meeting for Academy Lafayette, the year-end audit report. And so Stephen will guide us through this, and
All right,
we will
welcome
then
everyone to
take a vote.
this special board
There's
meeting
my
for
voice.
Academy Lafayette. The year-end audit report. And so Stephen will guide us through this, and all right, we will then. All right, you ready, Stephen?
Yep. All right. So the reports, we're going to start here going over the management letter. But I just want to remind us that the reports and the management letter have been provided in the shared folder for your reading and review. These highlights are my highlights. It's like maybe not a 10,000 foot level view, but maybe a 1,000 foot view, a little bit closer down overview to help facilitate this meeting. But please note that the entire reading is important of the financial statements. And there is a lot of information here, a considerable amount of information to unpack. So please, if you would, hold questions to the end, and we'll go ahead and get started here. So first, we're going to cover the management letter. There's a finding in there, so we'll talk about that. We'll go over the financial reports of financial results of 24-25 school year. We'll talk about the auditor's opinions and their highlights of the financial statements. Talk about fund balance, the reserve ratio, and then we'll ask for the board to motion to approve the audit. Can everyone see my screen okay? I know it might be kind of tiny if you're on a phone, but just to help guide us, I've got highlights throughout, and then I'll be going down through each of those highlights, reading over some of the text here. So first part is the management letter. And so this is to the members of the board of directors, so the board members here. And this is from Mueller, Oberfell, and Jones, our auditors. And so they've audited the modified cash basis consolidated financial statements of Academy Lafayette School for the year ended June 30th, 2025. Professional standards require that they provide you with information about their responsibilities under generally accepted auditing standards and government auditing standards, as well as certain information related to the planned scope and timing of their audit. They've communicated such information in their engagement letter dated June 30th, 2025. And so professional standards also require that they communicate to you the following information related to their audit. And so there's significant audit matters. And so they noted no transactions entered into by the school during the year for which there was a lack of authoritative guidance or consensus. All significant transactions have been recognized in the consolidated financial statements in the proper period. Accounting estimates. So certain accounting estimates are particularly sensitive because of their significance to the consolidated financial statements and because of the possibility that future events affecting them may differ significantly from those expected. Due to the school applying the modified cash basis of accounting, no estimates are made during the preparation of consolidated financial statements. They talk about difficulties encountered in performing the audit. They didn't encounter any significant difficulties in dealing with management. They talk about corrected and uncorrected misstatements.
Steven,
Yes?
can you do full screen or do you do full, how I presenting thing? Do you do full screen or?
Can you see that okay?
Yeah, I can see it, but I'm thinking about people watching it on YouTube. I don't know.
Yeah, we can see really well. It's in
You see it well?
Yeah, it's in full screen. It's all good.
Okay, because I'm looking at the Facebook. That's fine. The YouTube, see how it looks like. That's fine.
I'm just shrinking it, which is not as good, Steve.
I'm trying to keep the slides in screen as well. Is that helpful?
Okay? Okay, thank you.
Is that helpful?
That's fine. Thank you.
Okay. So corrected and uncorrected misstatements. So professional standards require them to accumulate all known and likely misstatements identified during the audit, other than those that are clearly trivial. They didn't find any. Also with disagreements with management for the purpose of this letter, they didn't have any disagreements with us. So they're pleased to report that no such disagreements arose. They do make they make management have certain representations, and so they request that management make certain representations, and so those representations include the organization's responsibility for preparing and fairly presenting financial statements in accordance with the modified cash basis of accounting, representations for the existence and accuracy of financial information, compliance with laws and regulations, and proper disclosure of risks, related party transactions, and subsequent events. Additionally, management acknowledges its responsibility for internal controls, fraud prevention, and compliance with federal programs, including maintaining documentation and taking corrective actions where necessary. They also talk about management consultations with other independent accountants. We didn't have any consultations with other accountants. Other audit findings and issues. They generally discuss a variety of matters within the report. And so other matters with respect to supplementary information accompanying the financial statements, they made certain inquiries of management and evaluated the form, content, and methods of preparing the information to determine that information complies with the modified cash basis of accounting. The method of preparing it has not changed from the prior period, and the information is appropriate and complete in relation to their audit of the consolidated financial statements. They've compared and reconciled the supplementary information to the underlying accounting records used to prepare the consolidated financial statements or to the consolidated financial statements themselves. They did note that there was a current year matter, and so during the school year, the school was under collateralized at two of the financial institutions. And so we'll talk about their finding in the audit report number 2025-001. And that's in the schedule of findings and question costs, and it can be found in the audited financial statements. So we'll go there and we'll talk about the finding. So the very end of the audit, they have pages 28, 29, and so they have the schedule of findings and responses. So with respect to the financial statements, they have three different categories here. Type of the auditor's report issued. The main auditor's report issued was unmodified. So there was no modification, there's no qualification of the audit. But with respect to internal control over financial reporting, they look at it to see if there's a material weakness. There was no material weakness identified there, but there was a significant deficiency identified. Non-compliance material to the financial statements noted, there was none there. So the actual finding, so criteria. As required by the revised Missouri statutes and the Missouri Financial Accounting Manual, all deposits must be secured during the year. So the condition during their review of deposits, it was noted that the school was underpledged with two financial institutions. Context. The school holds bank accounts with two financial institutions that were under collateralized for the year ended June 30th. Effect. So this is the risk. There's risk involved there. And so the risk is that the school's under collateralized balance may not be returned to the school because the balance is not covered under FDIC coverage or other pledged securities. And so if a bank went under, perhaps we would not get our money if it was at those two banks with under collateralized balances. Cause. Adequate oversight was not in place to ensure all bank account balances were secured through FDIC or other pledged securities. And so their recommendation, the school should periodically review the cash and investment securities pledged with banks to ensure the school's deposits are fully collateralized. View of responsible officials and plan corrective actions. So Academy Lafayette agrees with the finding. The school has already implemented corrective measures to mitigate this risk and ensure ongoing compliance with applicable revised revised statutes in Missouri, such as consolidating bank accounts, redeeming the certificate of deposit, and utilizing ICS programs, insured cash sweep programs. In addition, the school will conduct monthly and annual reviews of collateralization levels and has already strengthened internal oversight procedures. So that's the finding on page 28, excuse me. So they also have an opinion on compliance. So within the audit as well, page 20, report on compliance with state requirements. So management has a responsibility. Management is responsible for schools' compliance with their requirements. And so auditors have responsibility to express an opinion on management's assertions about the school's compliance based on their examination. They believe that their examination provides a reasonable basis for their opinion. And so their opinion on state compliance with state requirements. Except as noted in finding number 2025-001, in their opinion, management's assertions that Academy Lafayette complied with the aforementioned requirements for June 30th are fairly stated in all material respects. So in other words, you might say, the auditor's opinion is that management's assertions that the school complied with the requirements are fairly stated in all material respects except for their noted finding. They also issue a report on internal control. And so they report on internal control over financial reporting. In planning and performing their audit of the consolidated financial statements, they considered the school's internal control over financial reporting, internal control, as a basis for designing audit procedures that are appropriate in the circumstances for the purpose of expressing their opinions on the financial statements, but not for the purpose of expressing an opinion on the effectiveness of the school's internal control. A deficiency in internal control exists when the design or operation of a control does not allow management or employees in the normal course of performing their assigned functions to prevent or detect and correct misstatements on a timely basis. A material weakness is a deficiency or a combination of deficiencies in internal control, such that there is a reasonable possibility that a material misstatement of the school's financial statements will not be prevented or detected and corrected on a timely basis. A significant deficiency, and that's what we had, significant deficiency is a deficiency or a combination of deficiencies in internal control that is less severe than a material weakness, yet important enough to merit attention by those charged with governance. And so their consideration of internal control was for the limited purpose described in the first paragraph of this section, so up here. And so it's for the purpose described in the first paragraph of this section and was not designed to identify all deficiencies in internal control that might be material weakness or significant deficiencies, and therefore material weaknesses or significant deficiencies may exist that were not identified. And so they did identify certain deficiencies in internal control described in the finding 2025-001, and they considered that to be a significant deficiency. And so the corrective action plan, so like mentioned in their finding, we agree with what they found. And so during the audit period, certain bank accounts were not fully secured through FDIC coverage or pledged collateral, resulting in a temporary under-collateralization. This occurred due to insufficient oversight, internal oversight, and lack of routine monitoring of bank balances over $250,000 and respective collateral levels. And so the corrective action taken, we've already implemented corrective measures to mitigate this risk and ensure ongoing compliance. We did this in 3 steps here. So reduction of bank accounts. So we consolidated bank accounts at Central Bank into one checking account with a sweep account. And so that checking account set to a 0 balance and it sweeps into an insured cash sweep account. And then at Country Club Bank, we redeemed the certificate of deposit that didn't hold its own FDIC coverage. We had taken that out a few years ago for the bus loan, and so that we could have a lower interest rate. And so since we paid off that debt, we didn't need that certificate of deposit anymore. And so we redeemed that. There were no fees associated with that. We enhanced FDIC and collateralization controls by maintaining checking accounts at a zero balance and utilizing the insured cash sweep programs with both financial institutions. And so the school has eliminated future risks related to this under collateralization. And so the planned corrective actions has already been handled. But number one, implement monthly monitoring. So we're monitoring that monthly. Number two, strengthen internal control or internal oversight procedures. So we'll incorporate collateralization and verifications into our monthly routines. And then number three, annual review of banking relationships. And so, as mentioned, all corrective actions have been implemented as of the date of the audit. All right, so the unsecured amount at June 30th was $158,000. And so, like I mentioned, if a bank would have went under on June 30th, perhaps the school would have been out $158,000. And so we've mitigated that risk going forward. And you can find also that's noted within the financial statements, footnote C, page 8. Okay, so jumping into the auditor's report. So they put together the consolidated financials, or they audit the consolidated financial statements. And so some highlights to their report. So they report on the audit of their financial statements. And so they express an opinion. And so in their opinion, the consolidated financial statements present fairly in all material respects the financial position of Academy Lafayette in accordance with the modified cash basis of accounting described in Note B. And so they want to draw your attention to Note B, which describes the basis of accounting and a basis of accounting other than accounting principles generally accepted in the United States of America. So you might hear GAAP, GAAP financials. We don't have GAAP financials. We have modified cash basis, which is a basis of accounting other than accounting principles generally accepted. However, their opinion is not modified with respect to this matter. And so the financial statements are presented fairly. Note B, the basis of accounting. This basis recognizes assets, liabilities, net assets, revenues, expenses when they result from cash transactions, with a provision for recording investments, long-term receivables, capital assets, depreciation, payroll withholdings, long-term liabilities, such as capital leases. So that's why when we look at the financial statements monthly, we'll talk about cash in, cash out, because that's how we present the financial statements, is on a cash basis or a modified cash basis of accounting. Responsibilities of management. So management is responsible for the preparation and fair presentation of the consolidated financial statements. So management, that would be the school, we prepare the financial statements. The auditors are just auditing these prepared financial statements. Management is also responsible for design, implementation, and maintenance of internal control relevant to the preparation and fair presentation. We should have it free of material misstatement, whether due to fraud or error. And so this audit isn't looking for fraud, but if they find it, they would report on it. The auditor's responsibilities, they obtain reasonable assurance about whether the consolidated financial statements as a whole are free from material misstatement, whether due to fraud or error, and to issue an auditor's report that includes their opinion. Reasonable assurance is a high level of assurance, but is not absolute assurance, and therefore it's not a guarantee. And so they don't guarantee to always detect a material misstatement when it exists. Misstatements are considered material if there is a substantial likelihood they would influence the judgment made by a reasonable user. And so in performing their audit, they exercise professional skepticism, they identify and assess risks, they obtain an understanding of internal control, they evaluate the appropriateness of accounting policies, and they also conclude on if we have the ability to continue or have a going concern for a reasonable period of time. They're required to communicate with those charged with governance regarding, among other matters, the planned scope and timing of the audit, significant audit findings, and certain internal control related matters that they identified during the audit. And so there's supplementary information included with the audit. Their audit was, the audits conducted for the purpose of forming an opinion on the consolidated financial statements as a whole. The additional financial statements and schedules are presented for additional analysis. And so those are, like I mentioned, they're presented for purposes of additional analysis and are not required part of the consolidated financial statements. Such information is the responsibility of management and were derived from and relates directly to the underlying accounting and other records used to prepare the consolidated financial statements. In their opinion, the supplementary information is fairly stated in all material respects in relation to the consolidated financial statements as a whole on a basis of accounting described in Note B. Other reporting required by government auditing standards. So in accordance with government auditing standards, they've also issued their report for the purpose that the report is solely described. The purpose of that report is solely to describe the scope of their testing and internal control over financial reporting and compliance and the results of that testing, and not to provide an opinion on the effectiveness of the school's internal control over financial reporting or on compliance. So they're not expressing an opinion on the effectiveness on internal control. They're just looking at our internal controls, looking for any like significant deficiencies. And so that's where they would report on that. And so overall, that the first 2 pages, 3 pages, they're indicating that financial statements are presented fairly. The assets, liabilities, net assets, and its support revenues and expenses are presented fairly. So we'll look at the assets, liabilities, and net assets. And that's on page 4. And so the assets, we had total assets of 22 million. Liabilities, there were $7.4 million in liabilities, and then net assets of 14.8. So balance sheet, your assets equal your liabilities and your net assets together. So there's $22 million in your assets, and then there's $22 million in your liabilities and net assets. Page 5, it's the consolidated statement of support, revenue, and expenses, and changes in net assets. At the bottom of this, the change in net assets flows back to your balance sheet, essentially. So your net assets and at the end of the year ties to the page before, $14.8 million. But just looking at our total column here, we had change in net assets before the unwinding of the new market tax credit transaction of $2.9 million. And so excluding capitalized items, so things that we would capitalize, put on a balance sheet, and principal payments, so debt payments, those are excluded from this number, and as well as the forgiveness of debt. So Academy Lafayette received more than we spent by $2.9 million. And so if we were to compare that back to the financial statements that we presented in August, the major difference here is the forgiveness of debt from the new market tax credit transaction, and then the consolidation of the school's financial statements with the real estate entity. And so we would look at note A, where we talk about principles of consolidation. The accompanying consolidated financial statements include the accounts of Academy Lafayette, so the school, and AL Real Estate SPE, Special Purpose Entity LLC. And so collectively, the consolidated entity is referred to as the school. All material intercompany accounts and transactions have been eliminated in the consolidation. So we pay AL Real Estate rent, and so in the consolidated financial statements, that transaction, the rental income and rental expense is eliminated. It's a wash transaction because we pay ourselves that rent. Also on page 12, we talk about the new market tax credit transaction, so that MMTC. The school entered into a new market tax credit transaction in 2018. We unwound that in 2025. So the school exited the program in fiscal year 25, which resulted in forgiveness of the leverage loan receivable of $4.8 million, as well as extinguishment of the related debt of $6.8 million. This results in an increase in net assets of almost $2 million. And so the net here, so see note L, last paragraph, page 12, the net here that we had forgiven was $2 million of debt. So part of that new market tax credit transaction, if you remember, the school acquired the Armour campus, and there was a $7 million transaction essentially, and $2 million of that was forgiven. All right, so with that $2 million that's forgiven, the change in net assets is almost $5 million, so $4.9 million is the change in net assets. So we had an increase in net assets of $4.9 million. So the statement included on page 15. Let's see if I want to jump that far ahead. So part of the supplementary information, we also have this consolidating statement of support revenues and expenses, but it breaks it down into the school and the real estate entity. So you can see the school as a whole, and then the SPE entity as a whole. And so highlights here, the school had almost $24 million in revenue and support. The expenses of the school was about $20.8 million. And so the change in net assets before the unwinding was $3 million. And so before the unwinding, it was $3.1 million. As part of the new market tax credit, there was cancellation of the note receivable. We see that in note L. The cancellation affects the school's statements and results in a decrease in net assets of $1.7 million, which would be a deficit, is what the bank would see there, is what they would read. And so that 3.1 change in net assets, but we had that cancellation of the note receivable. So when the new market tax credit transaction happened back in 2018, the school was loaned $4.8 million, and they used those funds to loan it. They made a leverage loan to Academy Lafayette Investment Fund, and so then that got loaned to the SPE entity. And so part of the unwind is we give up that note receivable, but then we also get cancellation of debt of $6.8 million on the real estate side. So the real estate side had forgiveness or cancellation of debt of $6.8 million. And so the net between those two is that $2 million net forgiveness. And so when looking at those two entities as a whole, so when reading the statement on page 15, you must consider the consolidating entity. And so the consolidating entity had that $6.8 million forgiven. And so bottom line, when reading the combined statement, there is an increase in net assets of that 4.9, almost $5 million. And so just to boil it down a little bit, maybe a little bit simpler, Academy Lafayette received more than spent by $2.9 million, plus they had debt forgiven of that $2 million. And so that's for that $4.95 million in change in net assets happens. Page 17 here. So page 17 reports an increase in fund balance of $2.6 million. So this is what DESI looks at. So we had revenues of 23, almost $24 million. We had expenses of $21 million. And so this statement's expenses include capital expenses. So if we purchase buses, if we purchased land or buildings, this is where those expenses are included in this line. But the statements that we were just looking at just a moment ago, those expenses were not included in that expenditure line because those are reported on, for lack of better terms, the balance sheet. And so what DESI sees is a change in fund balance of 2.6, almost $2.7 million. And so DESI sees a surplus. DESI sees a surplus of that $2.6 million. And so this statement reconciles to the school's annual Secretary of the Board report. We also refer to that as the ASBR. And so we submit that annually in August. DESI sees an increase in our fund balance for 24-25. Statement of revenues, expenses, and changes in fund balance, modified cash basis, page 17 of the audit report. So total revenues was that 24 million, total expenses 21 million, and so we had a net increase of 2.6, almost $2.7 million is what DESI sees. As noted in August, from a cash in, cash out perspective, Academy Lafayette's cash increased by $2.6 million. And so also part of the financial statements are the notes to the financial statements, and they are a very important part of the financial statements. They provide additional context to the financial statements, their footnotes. And so, like the auditors mentioned in their report, they draw your attention to note B, the basis of accounting, because we're using a different basis than what's generally accepted. We don't have GAAP financial statements, so we don't account for accrued liabilities. So we don't have accruals, and that would be part of like a GAAP financial statement where we would have accruals. We don't keep track of those. We typically just look at cash in, cash out. Note L, like mentioned before, it talks about the new market tax credit. So it gives additional context. If we didn't have this footnote here, we wouldn't necessarily have a clear understanding of why debt was forgiven or why there was cancellation of debt. But because there was a new market tax credit transaction that happened in 2018, and there was an unwind or an exit in 2025, this helped provide context to that transaction. Page 13, note M, liquidity and availability of financial assets. So the school strives to maintain liquid financial assets sufficient to cover general expenditures and maintain financial stability. And so at the end of the year, we had almost $8.9 million in financial assets available to meet cash needs for general expenditures within 1 year. So it gives you a little additional information there. Note O, subsequent events. So they also report on anything significant that's happened after June 30th. And so a subsequent event that's happened after June 30th that might influence the reader of financial statements is on August 1st, 2025, the school entered into a note payable with the SPE entity, so our real estate entity, where there was refinance of existing loans on the Armour property. And so if you remember back in August, we had refinance of existing debt associated with, and this is associated with the exit of the new market tax credit program. So again, footnotes are very important. They provide additional context to the financial statements. One thing to note, I missed when we were talking about note M there, liquidity and availability. So that $8.9 $9 million. So financial assets available to meet cash needs for general expenditures within 1 year, the 8.9. So if you compare that to the prior year, the last year was $6.2 million. So there's an increase there from last year to this year, and that is an increase of $2.7 million. So the increase there of $2.7 million is mainly driven by state revenues that were better than budgeted due to higher per watt allocation in the basic formula payment. However, if you remember our last board meeting, we talked about the PYC, prior year correction. So the state made a change to the amount that we were paid. And so even though that they paid us on a higher amount per watt, they're still clawing back that $1.7 million this current year. And so if you look at that and net it together, really, we should have landed more with $1 million increase, and that still would have been mainly attributed to just a higher per watt amount than what we had budgeted. Other highlights, additional audit sections. So we've already talked about state compliance, but they issue a report on state compliance, and they look at, so they examine management assertions that Academy Lafayette, the school, complied with the requirements of Missouri laws and regulations. They did note where we weren't in compliance with respect to the under collateralized amounts. And then they also look at report on internal control. And we already read over the difference between deficiency, material weakness, and significant deficiency. And they reported that we had a significant deficiency with respect to internal control when they were looking at the under collateralized amounts. And then towards the end of the audit report, we already talked about the schedule of findings. So they report on findings for the current year and prior year. Looking at fund balance and reserve ratio. So included in your slide deck is a 10-year look at where we are at in our fund balance and the reserve ratio. And so we are on an upward, we're still on an upward trend. We've talked extensively within Finance Committee over the last several years about wanting to spend down the fund balance. But as we see even with this year, how there's prior year correction, there's still somewhat volatility with state, the formula payment. But as a generalized statement, we have a strong fund balance in that we have 8.8, almost 8.8 in fund balance. And when we compare that to our total expenditures and funds 10 and 20 or funds 1 and 2, we have a reserve ratio of 44%, almost 45%. And like I mentioned, we're still on an upward trend. We would really prefer to be, the board would prefer to be at closer to, I think, a 20% reserve ratio, or even maybe lower than that. And so we're still, we have paused for a moment on the amount that we were planning to spend this year. We were planning to spend $3 million of our reserve, but with the PYC, the prior year correction occurring, we're pausing on that. We're trying to assess those expenses that are non-essential before we spend that down. So key takeaways, the DESE financial statements, they see a surplus of 2.6, almost $2.7 million. On the bank side, the bank, when they would look at this, they would see that the school had a deficit of $1.7 million, but that the real estate entity had a surplus of 6.6, almost $6.7 million. And so when the bank's looking at the consolidated statements, they see a net change, a surplus of almost $5 million. From a cash in, cash out those perspective, we had an increase of $2.6 million. The difference between that 2.6 and the 4.9 is that forgiveness of debt. So that's, if you're wondering why there's a huge difference there, but it's because we had that forgiveness of debt of $2 million. The reserve ratio is at 44%. However, with that PYC, it would be closer to 35%. And we have a fund balance of $8.8 million. I know there was a lot there. Any questions over the management letter, the financial statements, or fund balance?
I have a couple of questions. So we operate on modified cash basis. Like, have you and the accounting firm evaluated with the school's growth and size and complexity? Is there any anticipated change to GAAP?
We haven't had that discussion. There was a consultant I met with about 9 months ago, just looking at going towards GAAP financial statements, just because a bank likes to have GAAP financial statements. And so, no, we haven't had those discussions with our accountants, but I have had that with a consultant.
Okay. Okay, yeah, just wondering as we get more and more complex and, talk about the different things that we're going to do. And then my other question was on the new market tax credit. I know you mentioned, into this year that August 1st note payable. Are there any other effects that could impact us this year from that unwinding, or was that kind of the last thing?
So one thing that came out of that is we have rental expense this year that we hadn't planned for during the budget. However, when we did the refinance, it essentially we're instead of doing a rental expense to the real estate entity, and I'm saying that wrong. Instead of having principal and interest payments on the loans, that's now within the real estate entity. And so the school has rental expense that's not budgeted. The school has principal and interest budgeted. And so by not having the principal and interest payments on the school side, it has rent expense. And I think we talked about that briefly in the board meeting, this past board meeting, or it was in the
The rent
finance
is what,
meeting.
and the rent is what's allowing the resident entity to pay for the principal and.
Yeah.
That's
yeah.
correct.
Okay.
Yep.
Okay. Okay. Yeah, there was like something I remembered in there, but it's like, what is it? Okay. I think that's all the questions I have. What about anyone else?
I'm wondering how we're going to restructure our repayment of the 1.7 million. Are we paying it all in one fell swoop?
No. I will say this, DESE did mess up, and they did reduce our December payment by that 1.7 million. However, they scrambled to get that paid, and so we were paid yesterday, our normal amount, but they are going to withhold that over the next 4 months. So January, February, March, and April will have a reduced amount by that $1.7 million. So it's spread over
That
4
will
months.
be the total then in that
Pardon me?
amount of time. That will bring us up to date. Okay.
That's correct.
And how many, 4 months, did you say?
4 months, yes.
Okay,
But really, we have the cash in the bank, so it doesn't.
right. Thank
It's
goodness.
not a hardship for us at this point.
And of that cash in the bank, so we know, let's just assume the 1.7 comes from that. Then we have what we have to reserve in the bylaws. And then is the rest of it, is any of it restricted by any of our bank loans or anything?
No, all of the reserve accounts have been released from restriction. And then also,
okay.
what you also might read in the financial statements, there is a column for donor restriction. However,
Right.
all of our deposits or all of our revenues that have been previously restricted have been released from restriction. So we had
Yeah,
at
I
the end
did
of
notice
June,
that.
at the end of June 30th, we had no restrictions on revenues.
Awesome. Any other questions?
I had a quick question on reserve ratio. You said with our prior year correction, we're down to that 35%. Is there a target range that we'd like to stay there for that reserve ratio?
So for our sponsor, we have to be at least at 8%. But we would prefer to be, I think uh, what the bylaws indicate is around, it's a range, so around like 12 to 20%, 12 to
Yeah.
18%. So
Correct.
And so even at the end of this year, once I think that this year we're projecting a small operating
surplus.
surplus, thank you. And then we're spending how much in capital? 1.5? I can't remember.
Well, we had planned the $3 million, but we've paused for a moment to reevaluate that.
But and how much is the surplus?
Pardon me?
How much is the surplus planned to be at this point? 500K? Is it?
No, I was thinking it was 800.
Okay.
Yeah,
So maybe
8
so it'd be maybe another 2 million down. So even if we were not changing anything, we'd still be above our 20%
That's correct. Threshold.
target by the end of the year. So you know, as hard as 1.7 million is, and that's how surprising it is, there's no financial crisis right now.
That's correct.
Right. All right.
I have a question,
Yes.
and my question revolves around that PYC. And I was wondering, with all of the charter schools and other school districts, have there been any collective action, or is everyone having to find the money to return the overpayment that DESE made, which was a mistake, but not purposeful or on purpose kind of mistake?
There's been a centralized, I would say, coalition with MCPSA. I mean, NOAA's been, on it, and in fact, like where DESE messed up and they didn't turn off the withholding for December, there was a big scramble by NOAA as an advocate for us to get those funds back to us on that scheduled time of January through April, rather than having that big hit in December.
But I think more importantly is like the issue of it's not how they take the cash, it's the fact that they take it in the first place. And I understand it's completely legal, and by state law it's expected they'll do prior corrections. It seems from coming from a private sector business standpoint that it's impossible for any entity to do any kind of budgeting, especially organizations that are watching cash so tightly, and it's going to be wrecking the finances of lots of institutions. It seems to me that there's a process problem that should be addressed, from a legal standpoint, the law,
Yes.
at legislature level. It's really crazy that the schools have to endure this kind of uncertainty.
Agree.
Yep, I agree too.
And I think they do have some control that they have to identify it and do this within a year, but
Mhm.
it's still,
Yeah,
yeah,
we spend
It's
money.
still a big
We're on a cash basis, so we
Right.
spend money as it comes in. So
right.
a year later, and thankfully we have a surplus, but I'm sure there's plenty of schools who just are very tight, and so to have that hardship coming up on top of everything else is really, the goal is public education. It's not to turn up a profit for the state. So
And my understanding is, and correct me if I'm speaking out of turn, but my my understanding is that is part of what NOAA and the association is working with DESE on, is kind of looking at the procedures and seeing where that can tighten up, because this, my also additional understanding is this isn't the first time it's happened. It's just, it's never been this significant before.
Yeah, and PYCs happen every year. I mean, we had one last year as well. It's just not this sizable.
Yeah.
And with the change in numbers that KCPS entered, that's where it really, messed up the payment for the charters. It's not their fault. It's how that formula has been written. And, the last few years, KCPS was able to rely on pre-COVID numbers. And so once that ran out, then it's not a solid number that they were relying on anymore. It was an estimated amount. And so that's where, that uncertainty comes into play.
But if the state was withholding $2 million or $3 million from KCPS, I'm sure everybody would hear a lot more about it than
That's right.
Right.
if you see what I mean.
More jump. Yep.
Right. Any additional questions?
Who who did the motion to
Yes.
approve the minutes? I'm trying to take minutes, kind of.
Okay, I was taking some minutes too, so we'll
Okay,
connect
then
it.
we can connect into it then. Sorry, that's fine.
Yes. All right, so, well, thank you, Stephen, Mr. Bang, the accountants, everybody. I mean, you do a lot of work to make an audit turn out this clean. And I know that's a sticking point, the one part on the notes on the insured, but anyway, it's great. You guys run the school very well, and I know we all appreciate it. So if I can get a motion to approve the 24-25 audit.
So moved.
Second.
Okay, Lauren, was that you?
Yes, it is.
Okay. All in favor?
Aye.
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 Any opposed? All right, motion carries.
Thank you.
Thank you.
Thanks
We
for
are
taking
good.
time on your holiday to meet. Appreciate you all.
Appreciate
Sure.
you too.
Thank you.
Thank you for all your
Thank you,
hard
Stephen.
work.
Happy New Year.
Happy New Year.
Happy New Year.
Bye.
Aye.